Hello, everybody. This is Toni Turner, and welcome to the market now as of Friday, August 6th at about 2 p.m. Eastern. Well, the Dow and the S&P 500 indexes scaled record highs today as shares in the economy-linked sectors jumped following a solid rise in jobs in July, helping allay fears of the Delta variant impacting a nascent economic recovery. Non-farm payrolls increased by 943,000 jobs last month, the Labor Department said today, amid demand for workers in the labor-intensive services industry. And on that cheerful note, let's go on to three charts that could give us some insight into the week to come. First of all, we're going to look at a chart of the daily chart, of the S&P 500 Spider, symbol SPY. Of course, this is the ETF that follows our S&P 500 benchmark index. We follow the SPY because it shows us volume, which an index can't show because indexes themselves are not traded. Their derivatives are. So we look at volume here. We see volume pretty average here, tapering off a little bit as it usually does in the summertime. When I captured this chart today, the SPY was trading at $442.65. That's a little bit over Thursday of this week. Thursday it made an all-time, that's August 5th, it made a new all-time, as it seems to do all the time, a new all-time closing high at $441.76. So we're a little above that now. We'll have to see at the close today if the market makes yet another new all-time closing high. Okay, so there's not much to look at here. The market has been, as we moved into the last weeks of earnings season, the market has been moving pretty much sideways, consolidating here above the 20-day moving average, the red line. We see that back on July 19 and 20, after moving up just in the most orderly fashion that I've seen in years, and it's been going on now since the beginning of the year, it finally moved down to the 50-day moving average again on July 19th and 20th, but bounced right back up again. So this is just, I probably shouldn't put a hex on it, but this is just a perfect move, not too steep, not too shallow, all the way up to where we are now at, yes, again, new all-time highs, 442.65. So right now we have new resistance, then we're going to say, short-term resistance at 443. We have support at the 20-day. The 20-day simple moving average is the red line. We have potential support with that line at $437.05, so 437 potential support. Of course, this 50-day moving average has been extremely important, as you can see, all the way through this year. And if we backed up on this chart and looked back into 2020, we would find it was the same for a while. So only one time back here in late February, early March, did it dip and close below with any falling at all. It closed below the 50-day moving average, but we're actually right on it. The dip before that, the pivot before that, same thing in January, closed right on that 50-day moving average. So except for this little blip here in June, where it actually closed below the 50-day, but it wasn't that much to really worry about. This market has been moving higher. So from my lips to God's ears, right? Again, we do have resistance up here now, potential resistance at 443. We have our support lines, as I said before, potential support at the 20-day, which the SPY has been using in the last week and a half, the 50-day, which it's been using for quite some time now. And so nothing to complain about, not much to talk about. Let's just keep watching it. And hopefully the Delta variant doesn't gain enough strength to get the market worried again. I am keeping stops in, of course, on all my positions, and we will watch the SPY in the coming week and see where it goes next. But please don't get too relaxed or too euphoric. That's always when something happens. So let's just keep an eye on everything and trade wisely. Our next chart today is the chart of the Invesco QQQ. This ETF represents the NASDAQ 100. As you know, that's a major index in the stock market. We like to watch it because the top components include Apple, Amazon, Alphabet, Facebook, Netflix, Microsoft, Intel, all of the big momentum, and in some cases we can say tech stocks. Now, Apple and Amazon themselves did dip today, as many NASDAQ and tech stocks dipped because the 10-year bond rates moved higher, and whenever interest rates move higher, tech stocks tend to fall. Although it wasn't too bad on the QQQs today. When I captured this chart, the Qs was trading at $368.21. We had Thursday of this week, August 5th, we had a brand new all-time closing high at $369.67. So we have a new resistance, we'll call it here, resistance high at about 370. Resistance remains here, as I said, at 370. Now you can see the red line, the 20-day moving average, has been acting since the first part of June, has been acting as a little mini short-term trend line here. So that 20-day moving average is coming in right now, if you want to make note, at $363.98. We could call that short-term potential support, although price is starting to hug it more and more. Remember, moving averages are kind of like magnets. Price will always come back to its moving average at some point. So, and right now, we can see where the Qs are kind of hugging or holding on to this 20-day moving average a little closer. The more important average for our purposes is the green line, the simple 50-day moving average, and that potential support is coming in right now at $352.84. You can round it off to 353 if you want to write that down or put it at your elbow if you're not watching this chart. So we do have, then we can say, resistance up here at about 370. We do have support at these two moving averages, and then course on down to the 200-day moving average coming in at $324.62. So we also don't have anything to complain about here. If bond rates continues to rise, then of course that will be helpful for financials, and it will put a damper on some other sectors, and we'll see how that goes and see if we need to get into that next week. So let's see if the Qs can stay above their 20-day moving average in the coming week. More importantly, let's keep an eye on our trades if the Qs get anywhere near the 50-day moving average, if there's any weakness that's signified at all. Just as I said, let's be wise. Let's not get too relaxed or too euphoric. Let's be wise. Okay, our final chart for the day. We haven't looked at this ETF in a very long time. However, we may have a good entry here depending on what the market does next week. We're looking now at a daily chart of the Select Sector Spider Materials ETF, symbol XLB. It has 28 holdings in it, including Sherwin-Williams, Air Products, Freeport-McMoRan, DuPont, that whole group. Now, when I captured this chart today, the XLB was trading at $84.10. As you can see over here, back in December, the XLB was trading down here in the 72 zone, pretty much walking up its 20-day moving average, but then dipping. The one time it dipped pretty dramatically this year below the 50-day, didn't stay there for long, but stayed below the 20-day, down below the 50-day for only like 5 days. Then it jumped back up and moved in a very nice uptrend, as uptrends do when they get more and more steep. They tend to fall, and that happened, of course, in May, and the XLB rolled over. Then it consolidated into June below its 20-day moving average again, dipped down to these lows down here at about 78.50, then jumped up and moved back up above the 20-day moving average. Now, if this turns into this kind of consolidation pattern that usually moves higher from here, as I've seen many times, of course, that will be a good thing for the XLB. I'm not going to give it too much room here. I want to trade it, but I'm not going to give it too much room. And I'm just not in the mood to do that and give back any of the profits I have on any of the other trades where I've taken profits. So if we look at the XLB here, we see that it moved down, bounced back over very quickly, bounced back over its 20-day and now 50-day. If we look down, we see the RSI is not overbought. We see that the MACD is right now moving above its 50 line, or a zero line, I should call this, the zero line. That can be a buying decision for many traders when the MACD moves above the zero line. So we can see the XLB sitting above, its moving averages are close together but inverse right now. So the 20-day is actually below the 50-day, and if price stays here, right now it's at $84.10. If price stays above the 20-day this week, I'm going to use that one in the coming week, the 20-day is at $82.37. So if in the coming week the XLB stays above the 20-day moving average, again coming in at $82.37, I will add a small position to my trading portfolio, and I will put in an initial stop pretty tight at $81. Now, when and if the XLB moves above $85, I will add to my position, because then the next resistance is up here at about $88. So if it can stay above, I'm sorry, $91. So if it can stay up above this 20-day moving average again, I will buy a small position if the market continues to be positive. If it moves above 85, I will add to my position, and of course my stop will be turned into a trailing stop. So if the market remains strong in the coming week, you may want to keep an eye on the XLB. And now, before we go on to final thoughts, please know that if you'd like to become a more successful trader, please check out my trader training programs. You're going to like my simple strategies. They're targeted to swing trading, trend trading, bottom fishing, 7 steps to successful trading, and much, much more. And they can help you increase your gains quickly and easily from now on. To see all of my online training programs, simply go to the link on this screen, or easier still, click on the orange button below. And now let's go on to final thoughts. This week's question of the week is, when I trade, how often do I use the 1-2 punch, hope then rationalize strategy to stay in losing trades? Now, in our everyday lives, hope is a wonderful emotion, absolutely a wonderful emotion. Hope is the basis for positive expectations, and that's a good thing. Especially in our social lives, hope supports our actions and it helps us to succeed, and I love it. In trading, however, hope can be detrimental to our wealth. It can be especially detrimental when we confirm it with rationalization. And we tend to do that in trading. The more we hope than rationalize, the longer we can justify staying in trades that we shouldn't be in. So we're going to call them what they are, losing trades. Now, it stands to reason when we enter a trade, we hope the stock moves higher or lower if we're selling short. We'll just use higher here for the sake of talking about it. But of course, we hope our stock moves higher. That's human. And while a little hope isn't a bad thing, when we let it rule our emotions, it can cause us to make really unwise decisions. So if our stock falls through our stop, if our stock falls through our protective stop that we put in, and we don't exit at that moment, it's at this point that we start rationalizing. So we already hope, right? We hope it wouldn't go down, but it did. Now we start rationalizing. This is a great company. It'll come back. I mean, I have heard that thousands of times from traders. And early on, I did it myself. Or, well, the market's just pulling back a little here. It's really, if you look on a monthly chart, this stock's in an uptrend. Or you say, you know what, this isn't a short-term trade. I really, really meant this to be a long-term trade. And that's all rationalization. So as a final resort, and what I did in the old days of trading, I would take the stocks chart off my screen entirely and say, all right, I'll look at it again tomorrow. Total avoidance. So please know that what happens in the stock market is totally unpredictable, and it can defy at times rational explanation. Therefore, it's up to you to strive to trade with a neutral mindset. If your position falls to your protective stop, you've planned it, right? And then you feel hope rising in front of you, and worse, you begin to rationalize, I hope it doesn't go any lower, but it's okay. It's a good company. It'll come back. Please exit the trade, or at least set an automatic stop with your broker, and make sure it's taken care of, and then maybe walk away from your computer. But make sure the trade's taken care of first, one way or the other. Remember, hope is a wonderful emotion in our everyday lives. Rationalization is also a helpful human trait. But when we're trading, hope directs us to make irrational decisions. I've done it. I've seen it done. Please know that. Rationalization to defend our hopes simply leads to more hope, and as more and more of our trades head lower. So take all the steps you can to keep hope followed by rationalization away from your trading mindset, and replace them with calm confidence. Not confidence that your trade's going to go higher. Hopefully it does. But if it doesn't, you want calm confidence in your ability to be disciplined, to plan a good plan for your trade, and then to trade that plan, okay? So you want to replace your hope and rationalization with calm confidence, a neutral mindset, and a plan for each trade that you follow. Finally, please know that if you'd like to become a consistently winning trader, this is a great time to check out my trader training programs. To see all of my online training programs, simply go to the link on this screen or click on the orange button below. Until next week, keep green on your screen. I'm Toni Turner, and this is The Market Now.